Hello, everyone. Welcome back to another powerful session of our series Super Sunday and Super Saturday. Today is Saturday, as you can see right here on top. So, we are going to start Super Saturday and Super Sunday. Continue, I mean. So, last session we were discussing audit. Sleep with a dream, wake up with a purpose, and live by actions. We were discussing chapter number 2. However, we are doing the essay 240 revision right here. We saw these some things. So, a quick recap of the same I would like to give. The auditor's responsibility relating to fraud in an audit of financial statements. Objective is to identify and assess the risk of material misstatement in financial statements due to fraud, to obtain sufficient appropriate audit evidences about the assessed risk of material misstatement due to fraud or error through designing and implementing appropriate responses and respond appropriately to identified or suspected fraud. Then we have meaning of fraud and its characteristics: intentional or unintentional, individual amongst management, TCWG, employees, or third parties involving deception to obtain an unjust or unfair advantage. Fraud. Misstatement resulting from FFR, fraudulent financial reporting. Misstatement resulting from misappropriation of assets. Okay, so there are two types of frauds. Then we have how fraudulent financial reporting may be caused by entities. Fraudulent financial reporting involves intentional misstatements, including omission of amounts or disclosures in financial statements to deceive financial statement users. It can be caused by efforts of management to manage earnings in order to deceive financial statement users by influencing their perceptions as to entities' performance and profitability. Such earnings management may start out with small actions or inappropriate adjustments of assumptions and changes in judgments by management. Pressure and incentives may lead these actions to increase to the extent that they result in fraudulent financial reporting. Such a situation could occur when, due to pressures to meet market expectations or a desire to maximize compensation based on performance, management intentionality takes positions that leads to fraudulent financial reporting by materially misstating the financial statements. In some entities, management may be motivated to reduce earnings by a material amount to minimize tax or to inflate earnings to secure banking finance. Fraudulent financial reporting may be accomplished by the following: manipulation, falsification, including forgery, alteration of account records, or supporting documents from which financial statements are prepared, misrepresentation in or intentional omission from financial statements of events, transactions, or other significant information, intentional misapplication of accounting principles relating to amounts, classification, manner, and presentation and disclosure. So, one you can remember by ABCDP: amounts, classification, manner, presentation, or disclosure. Manner of presentation or disclosure. Then we have fraudulent financial reporting involves management override of controls otherwise may appear to be operating safe effectively. Fraud may be committed by management overriding control using such techniques: recording fictitious journal entries particularly close to the end of an accounting year to manipulate operating results or achieve certain objectives. So we can say these are cut-off transactions, as we've already discussed, inappropriately adjusting assumptions and changing judgments used to estimate account balances, omitting, advancing, or delaying recognition in financial statement of events transactions that have occurred during the reporting period, concealing or not disclosing facts that could affect the amount recorded in financial statements, engaging in complex transactions that are structured to misinterpret the financial position and financial performance of the entity, altering records and terms related to significant and unusual transactions. Then we have how misappropriation of assets may be caused by entities, which is Misappropriation of assets involves the thefts of entities' assets and is often perpetuated by employees in relatively small or immaterial amounts. However, it can also involve management who are usually more able to disguise or conceal misappropriations in ways that are difficult to detect. Misappropriation of assets can be accomplished in a variety of ways, including embezzling receipts, for example, misappropriating collections on account receivable or diverting receipts in respect of written off accounts to personal bank accounts. Stealing physical assets or intellectual property, for example, stealing inventory for personal use, for sales, stealing scrap for resale, colluding with an employee, colluding a colluding for resale, colluding with a competitor by disclosing technological data in return of payment, causing an entity to pay for goods or services not received, for example, payments for fictitious vendors, kickback paid by vendors to the entity's purchasing agents in return of inflating prices, payments to fictitious employees, using an entity's assets for personal use, for example, using the entity's assets as collateral for a personal loan or a loan to a related party. Misappropriation of assets is often accompanied by false or misleading records or not sure. Just a moment, I'll be right back. Order to conceal the fact that the assets are missing, I'll be attending the call later on. The fact that the assets are missing or have been pledged without proper authorization. Although the auditor may suspect or in rare cases identify the occurrence of fraud, the auditor does not make legal determinations of whether the fraud has actually occurred. Whose responsibility is to prevent and detect of fraud? The primary responsibility is that of management. Primary responsibility for prevention and detection of fraud rests with both TCWG of entity and management. TCWG plus management. Okay. With the oversight of TCWG, place a strong emphasis on fraud prevention, which may reduce opportunities for fraud to take place, and fraud deterrence, which could persuade individuals not to commit fraud because of the likelihood of detection and punishment. This involves a commitment to creating a culture of honesty and ethical behavior, which can be reinforced by an active oversight by TCWG. Okay. Then we have what is the responsibility of fraud? Why are we being considered here? And what are our responsibilities in the regard to the same? So you can see that this one is pretty big, which is why we're planning on taking multiple sessions. Let me now see. So let us see what is the responsibility of auditor. We'll be reading this much only and then we'll be proceeding with fraud risk factors in the upcoming next session. An auditor conducting an audit in accordance with SEC is responsible for obtaining reasonable assurance that the financial statements taken as a whole are free from material misstatement, whether due to fraud or error. Owing to the inherent limitations of audit, there is an unavoidable risk that some material misstatements of financial statements may not be detected, even though the audit was planned and performed in accordance with SAs. The potential effects of inherent limitations are particularly significant in case of misstatement resulting from fraud. The risk of not detecting a misstatement resulting from fraud is higher than the risk of not detecting one resulting from error. This is because fraud may involve sophisticated and carefully organized schemes designed to conceal it, such as forgery, deliberate failure to record transactions, or intentional misinterpretation being made to the auditors. Such attempts at concealment difficult be even more difficult to detect when accompanied by collusion. Collusion may cause the auditors to believe that audit evidence is persuasive when in fact they are not. When in fact they are false. Auditors' ability to detect a fraud depends on factors such as skillfulness of the perpetrator, the frequency and extent of manipulation, the degree of collusion involved, the relative size of individual amounts manipulated and the seniority of those individuals involved. While the auditor may be able to identify potential opportunities for fraud to be perpetuated, it is difficult for the auditor to determine whether misstatements in judgment areas such as accounting estimates are caused by fraud or error. Furthermore, the risk of auditor not detecting a misstatement resulting from management fraud is greater than for employee fraud because management is frequently in a position to directly or indirectly manipulate accounting records, present fraudulent financial information, or override controls procedures designed to prevent similar frauds by other employees. When obtaining reasonable assurance, the auditor is responsible for maintaining professional skepticism throughout the audit, considering the potential for management override of controls and recognizing the fact the audit or that audit procedures that are effective for detecting error may not be effective in determining fraud detecting fraud. So that was about our discussion. We discussed about 2.5 pages, which is a good productivity as per the time limit, time duration, and the amount of content discussed right here, and also the productivity that has been generated, I can say. So that was about our session. This is me, CA Kajol, signing off. Thank you.